Hello, everyone, and I appreciate you taking the time to attend this call. I'm Sid Rajeev, Head of Research at Fundamental Research, and our guest today is Phillip Burns, CEO of European Residential REIT, also known as ERES. ERES owns multifamily rental properties in Europe with a special focus on the Netherlands. The company is backed by Cap REIT, the largest residential REIT in Canada. ERES is also one of the highest dividend yielding residential REIT in North America and Europe. They reported strong results yesterday and announced an increase in monthly dividends. So the agenda for today is I will kick off the call with our thoughts on a sector that we believe is highly attractive in this uncertain and low interest rate environment. Philip will take over from there and introduce us to his company, highlight some upcoming catalysts and things we can watch out for. For listeners, you can either wait till the end to ask questions, or if you have questions during the presentation, feel free to type them in and we'll try to respond to them. We encourage questions to be directed to ERES since we have Philip on the call today. Here are some key disclaimers. Please take a moment. Okay, so let's get started. Interest rates across the globe are at record low levels. The charts here show the US Fed funds rate and the rates in euro. Fed's chair Jerome Powell stated 2 days ago that interest rates would stay low for a long time. He indicated that it'll take 3 years for the US to achieve its inflation target, implying that they are unlikely to raise rates before 2023. We expect rate hikes sooner as we believe inflation will start to kick in with an economic recovery in the second half of this year. That said, we expect rates to remain very low throughout the year. Considering the low interest rate environment and uncertain market conditions, a sector we are very bullish on is the multifamily residential market. As shown here, multifamily properties were one of the best performing assets during the pandemic, with very low delinquency rates among other property types such as retail, lodging, student housing, offices. This is primarily because of the benefits offered by governments to unemployed individuals and businesses to retain employees. Now, CBRE recently conducted a survey and asked, how long will it take for investment activities to return to pre-pandemic levels? As shown here, multifamily properties are expected to be one of the most resilient sectors. The pink bars imply longer recovery time. As a more resilient, multifamily has seen a significant increase in appetite from investors during the pandemic. As indicated by the blue bars here, this chart compares the investors' appetite for sectors during COVID versus 2019 and the global financial crisis. Multifamily and industrial saw a significant increase in demand versus office, retail, or hotels. Now let's look at valuations. Cap rates in the US increased for all property types, and an increase in cap rate implies a decline in valuations. Multifamily's cap rates increased, but only slightly versus other assets. Based on the slight increase in cap rates and other fundamental benefits of multifamily units I mentioned earlier, multifamily investments are expected to significantly increase this year in the US. This is the case in Canada as well. Although lack of new immigrants and international students had a significant impact on the country's rental market, we expect a surge in both new immigrants and students once travel restrictions are relaxed and conditions normalize, which is why we believe investment in the country are also expected to increase this year. Now, before I invite Philip, I would like to show you a table with some key Canadian and European REITs. These REITs have an average dividend yield of 3.1%. ERES is one of the highest dividend yielding REIT at 3.8%, marked in green in this chart. ERES's focus is on rental markets in Europe, with a special focus on the Netherlands, which we believe is one of the most attractive regions in Europe due to its relatively strong economy and persistent housing shortage. As shown here, Netherlands unemployment rates have been declining steadily in the past few months, which is extremely critical for the health of multifamily properties. With that, I would like to welcome Philip CEO of ERES. Philip, you'll be able to share your screen now. Please go ahead when you're ready.
Thanks, Sid, and thank you everybody for joining us and taking time to hear the ERES story. We'll just wait till we get the slide up. Thank you. If we just roll forward, Nicole, who will be driving the deck for me, to page 4, just as an overview, you can see in this slide that ERES has about 6,000 units in the Netherlands. And just to give a perspective, that represents about 1.5 billion euros in assets. So we already, although we're a relatively young company, only 2 years old, we've already established scale, and we have a current market cap of about 960 million. You can also see on this page that our assets are distributed throughout the country, which we think is very important because it gives us diversification. We have 40% of our assets in what's called the Randstad, which is the high urban areas that encompasses the 4 biggest cities of Amsterdam, Utrecht, Rotterdam, and The Hague. And we have 60% of our assets in other areas throughout the country. On the next page, you can see something that Sid referenced. We have a very strong partnership with Cap REIT, which is Canada's largest multi-residential REIT. They've been in business for over 25 years, and they have an extremely successful track record, both in delivering shareholder returns, averaging 14% per annum, as well as growing their portfolio consistently over time at 20% per year. Cap REIT not only provides asset management and property management services to ERES, but they're also our largest shareholder. In summary, we think the investment highlights for ERES is an opportunity to invest in a unique and Canada's only listed European REIT that focuses on multi-residential in Europe. We buy at attractive yield spreads, and I'll explain that in a minute, and we can drive long-term rental growth on top of those yield spreads that drives long-term consistent earnings growth and ultimately allows us to pay the yield that Sid was mentioning and continue to grow that yield over time. We are an established platform because we have all of the resources of Cap REIT, and we already have a very significant portfolio, as I've mentioned. We don't rely on leverage. We keep our debt ratio between 45 and 50%. Then we have a very experienced management team and the board of directors that has experience in both Canadian real estate and Canadian capital markets, as well as European real estate and European capital markets. Just really quickly on the next page, it just shows some of the dynamics of Europe in general. If you think of the Euro area, it's the second largest or third largest, depending upon China's current numbers, economic area globally. So a very robust place to deploy capital. And I often like to say that Europe is never too hot or never too cold. When things are going well, it has higher growth rates, but never growth rates that you might see in other more dynamic areas. But it also never has growth rates that are too low on the downside. And since the financial crisis, unemployment has continually and steadily coming down across the board in Europe. Of course, that changed a little bit with COVID, but as Sid's slide demonstrated, in the Netherlands, we've already reached the peak unemployment as a result of COVID, which is only just over 4%, and it's already started to come down. With the Netherlands specifically, there's a couple of things that one needs to understand and appreciate. Number one, it's one of only 10 countries that remains a AAA rated company. So it's very, very economically sound. It's also important when you're talking about multi-residential. It's the most densely populated country in Europe and one of the most densely populated countries globally. So there isn't the ability to add incremental supply, and there currently is a very severe supply-demand imbalance or a shortage of housing. You can see that on the following page, where on the left-hand top side, every year there's a shortage of housing currently and projected to the future, such that the shortage is getting worse before it ultimately is forecast toward the end of the decade to start to remediate. But I highly doubt that that will happen because they're just not making progress in delivering enough units to offset the annual deficit. This drives one of the most important fundamentals of Dutch real estate. and that is in the bottom half of the page. You can see that it's a very busy chart, but the dotted line represents for the past 40 years, the nominal rental growth has been 4%. That's been a bit volatile over time, as you can see with the green line, but even during the global financial crisis, we had top line rental growth. And so that brings me to one of the two very important things about the value opportunity with ERES. Number one, we buy at attractive yield spreads. So we can buy at cap rates between 3.25% and 4.25%, which would be very favorable compared to North America or Canada specifically, and probably much more favorable as you get to the top end. But equally importantly, we can finance those purchases in the European debt market at around 1% to 1.25%. We recently put in new financing for our most recent acquisitions at 97 basis points, so less than 1%. So if we can buy at 3.25, we're putting in place on day one 225 basis points yield spreads that stick with us throughout the course of holding these assets. And if we buy at the higher end of the cap rate range, we can get up to 300 basis points yield spread on day one. So we can buy at attractive cap rates and we can finance them incredibly cheaply. And you can see that we've been doing that consistently since our inception in 2016. We've grown our assets by almost 120%. And as I mentioned earlier, we're sitting at over 6,000 units today, or almost 1.5 billion euros of value. The second important part of our story is our ability to drive rental growth, or our rent maximization strategy. On top of being able to put in place on day one yield spreads of 200, even 300 basis points, we then can deliver top line rental growth of between 3 and 4%. And given that our margins are largely fixed, most of that drops down to the bottom line, so that we anticipate our earnings growth to be between 8 and 10% per annum. That allows us to be able to continue to invest in the assets. And most importantly, it allows our shareholders, our unit holders, to have confidence that our distributions or our dividends are secure, recurring, and will grow over time. As Sid mentioned, with our earnings this week, we announced a 5% increase in our dividend. And although I agree with all of Sid's slides, the one thing that I don't agree with is actually ERES's current yield is even higher than he illustrated. If you take our new yield off our new distributions, our yield currently with today's prices would be about 4%. So that wouldn't put us near the top. It would actually make us the highest paying dividend play in the Canadian REIT multifamily space. And with that, Sid, perhaps I turn it back over to you. If you'd like us to go into more detail for those on the line, or if you want to ask some questions, please let me know.
Thank you so much, Philip. We can now open the call to a Q&A. Listeners, if you have any questions, please feel free to type them in, or you can click on the raise hand option and I can unmute you. So Philip, we have already received some questions. I'm just going to compile them. Basically, the first question is, can you please talk about the delinquency rates on your properties through the pandemic?
Yes, throughout the pandemic, we are very proud to result that our delinquency rates did not change at all. We actually, throughout the course of 2020, not only were consistent with our historical collection rates, but on average, we were collecting slightly over 100% of our rents each month. So what that means is that we were not only collecting current rents, but we were actually working on historic rental balances. Not from previous poor performance, but when we buy portfolios, we often bring with those portfolios historic rental arrears. And so throughout the course of 2020, we were able to keep our collections constant, and we brought down our historic rental arrears by 10%. So I think it's very, very unique to the Dutch and European multi-residential space that we can perform that consistently during a pandemic such as COVID-19.
Nice. Another question is on the occupancy rates and pandemic's impact.
Once again, due to the defensive nature of our portfolio, we actually have had no impact in our occupancy rates, or they have not deteriorated at all. We came into 2020 with about 97% occupancy, and we exited about 98.3%. We did improve, but that's largely because we came into the year with slightly elevated vacancy because of some portfolios that we had bought at the end of last year, but we were able to remediate that vacancy and sustain our occupancy rates at very, very high levels of almost 98.5%. And 60% of our vacancy is offline intentionally because we're refurbishing those units so that we can get further rental growth when we put those units back into the market.
Okay. What's the ideal target size of your portfolio by the end of 2021? I guess the question is, are you planning to aggressively acquire?
We do plan to acquire. Again, if you recall the slide that I showed with CAPREIT, they've consistently grown over time since their inception. They were growing at 20% per year. On average, they were acquiring a couple of thousand units. Canada is a bigger market than the Netherlands, but we would continue to expect to maintain a very, very healthy external growth rate. We did pause on our acquisitions in 2020 for 2 quarters, through Q2 and Q3, because we wanted to ensure that we protected our liquidity, ensure that we gave our portfolio the chance to perform as we knew it would. So we didn't start acquiring until Q3 and Q4, where we did do 4 transactions at very attractive prices between 3.5% and 4.25% cap rates. And we would expect to continue to grow going into 2021 as we've demonstrated externally how defensive, how robust, and how secure our portfolio is. We also have significant access to liquidity. We have undrawn lines of over 100 million euros. With that alone, we could acquire almost 250 million euros worth of assets. And we also, furthering the partnership with CAPREIT, they provide us 165 million incremental, what we refer to as a pipeline agreement, which just allows us to grow further. Of course, we're very happy to issue equity and continue to grow our market cap, continue to grow our free float, but we don't want to issue equity at depressed levels. And currently we're trading at plus or minus a 15% discount to NAV. So we think that it's a great opportunity for people to come in now and buy at a discounted price. And we certainly don't anticipate issuing equity at those levels, but we can continue to grow because we have access to other components of liquidity.
Okay, now the next one is, do you have plans to expand outside the Netherlands?
The short answer is yes, but the timing is probably more in the medium term. When we created ERES, we called it European Residential REIT. CAPREIT's history, they grew over time and they consistently moved from province to province across Canada, recognizing all the nuances that one might encounter as you go from one provincial framework to another. CAPREIT then sponsored another entity in Ireland that's called ERES Residential REIT, which I'm also on the board of. And then CAPREIT, after successfully exporting their model to Ireland, has now exported it to the Netherlands. And we didn't call it the Dutch Residential REIT, and we didn't call it the Netherlands Residential REIT, because we do believe that there is the opportunity to further export the ERES and CAPREIT model to other places in Europe, basically professionalizing the residential asset class, creating a professional landlord that puts the tenant first, yet still driving attractive returns to shareholders. So we do see opportunities to go into other parts of Europe. We would stay focused on the core areas like Germany, France, Belgium. I really wouldn't foresee us getting into more of the southern European countries because of the economic challenges that they have, like in Italy or perhaps in Spain. But over the medium term, we certainly would expect to expand outside the Netherlands. And we also see significant runway to further build our portfolio, further build scale in the Netherlands. We believe that our addressable market is probably close to 1 million units, and the largest player only has 30,000 units. We have 6,000 units. So you can see there's a lot of scope for further growth within the Netherlands, but we certainly do have our eye on other places within Europe.
Next one, the Netherlands government announced a 0% growth rental policy for regulated properties? How does that impact ERES?
Yeah, so in order for me to answer this question, I have to explain a little bit of how the regulations work. And if we go back to our rent maximization strategy slide, our rental maximization strategy has multiple components. First, we have our turnover. That's when tenants are moving out. And our turnover rates are lower than you would see in North America or Canada. Our turnover rates are, 12, maybe 13%. And the regulations don't really apply to that, either the regulations that were just announced or in general, the regulatory regime, which is quite complex. So upon turnover, we can take our regulated units, which is about 45% of our portfolio, to the maximum allowed under the regulatory system. They tell you for each flat, depending upon its characteristics, how high you can raise their rents. So on turnover, we can take it to the maximum. For the non-regulated units, which is about 55% of our portfolio, we can take that as high as the market will allow. For renewals, for people staying in their flats, it's quite unique in the Netherlands where everybody, regardless of when you moved in, regardless of when you signed your lease, everybody gets a rental increase on the same day each year, and that's July 1st. And for the regulated units, the government tells you how much you can raise that rent, and it largely depends upon your income level. For the liberalized units, there isn't a maximum. You only have to be aware of your leases. Some leases provide caps, but they're very generous, like CPI plus 5%. And what the government has done is they've said for 2021, the maximum amount you can raise rents for your regulated units is 0%. They haven't changed the law. They haven't changed the framework. They've just said for this year, we don't want to see rental increases because they want to protect the lower income people who are resident in the regulated units, particularly in light of COVID. It will have an effect on our top line growth, but we still feel very confident given the robustness, the diversification across our portfolio with regulated and liberalized or non-regulated units that we still will achieve our 3 to 4% top line target. So as we demonstrated toward the end of last year, we can continue to buy at very attractive rates. We can finance them very, very attractively to put in place 200 to 300 basis points yield spreads on day one. And then we can grow that top line from 3 to 4%. And although the regulations have been modified for this year, we still feel confident being within that range.
Okay. I think we are reaching I think this is the last question, or maybe we have two more. Are you seeing property valuations lower these days in the Netherlands and the rest of the Europe? Are there any attractive regions that you're targeting?
Well, the one thing which perhaps may be counterintuitive is that throughout 2020, even with the COVID pandemic, the Netherlands will have seen at or near the highest ever transaction volume in the residential asset class. Why is that? Well, on the new build side, there continues to be a need to deliver product because there's such a shortage of housing. But even on the stabilized existing portfolio, there's a lot of insurance companies, pension funds that are rotating that stock, and people like CapREIT and others and ERES are buying that stock. And because it's performed so well historically and performed so well throughout the pandemic, we actually saw prices increase or cap rates come down during 2020. Of course, everybody likes to see prices get cheaper. But again, if we can continue to buy at the yield spreads that I've explained, and that we can continue to drive the top line in the manner that I described, we think it continues to be very, very attractive. In other parts of Europe, there's different dynamics in each place of how the yields are trending. But generally, we don't believe that the COVID-19 pandemic has created a fire sale for residential assets.
Okay. Final question. I think this is related more to capital structure. Basically, I'm just going to rephrase the question here. So CapREIT owns, does CapREIT's significant ownership, it's come off as a challenge when it comes to potential M&A or some bigger REIT targeting ERES as an M&A opportunity? Does CapREIT's significant ownership affect that?
Well, The first thing I would say is CAPREIT's majority ownership and sponsorship of ERES is only a positive. When ERES was created at the beginning of 2019, CAPREIT already had a presence in the Netherlands, and they created ERES. They created that platform so they could continue to grow that platform, but also bring in outside investors so that they can grow it in partnership. They never anticipated using ERES as a mechanism to sell down their stake in any way. And to that point, they've never sold a single share. When we raised equity in September and December of 2019, although CAPREIT's ownership percentage came down, in each occasion, they invested more absolute capital. So CAPREIT continues to be a very, very big sponsor and supporter of ERES. And ERES's primary strategy is to continue to grow and to continue to utilize that CAPREIT platform to drive value for shareholders. We have no interest in selling our platform to another player. On the M&A front, we would consider M&A where ERES would be the acquirer. And in such a situation, CAPREIT would be incredibly supportive because, as I mentioned, although in addition to being the largest shareholder, as well as having the pipeline facility, they would give us incremental horsepower, incremental balance sheet to do something very progressive if that opportunity presented itself. We're currently not in any M&A discussions, et cetera, but if an M&A discussion were to present itself, ERES would want to be in the acquiring position as opposed to potentially selling the platform.
Philip, that was very useful. I don't see any more questions. Thank you so much, Philip, and everyone out there, all attendees for taking time today. A recording will be uploaded on our channels shortly. As mentioned earlier, if you wish to see our reports on ERES, please sign up and be a member at researchfrc.com. Thanks again and wish you all the best and stay safe.
Thank you, everybody. We appreciate you taking the time.
Hello, everyone. My name is Karim Farouk. I'm the Managing Director and Head of Operation for ERES in the Netherlands. Welcome to the ERES Virtual Property Tour. During this tour, you will notice not only the quality and efficiency of our operating platform, but also you will see the technology we are using to rent out our properties, such as drone views of our neighborhoods, in-suite 360 tours, and virtual room measurement tools. The first property in this tour is called the Chameleon. Located in the southeast Amsterdam, in close proximity to the city center, and has a direct access to the city's extensive train network. It is accessible by metro across the street that leads to Central Station in 15 minutes. Southeast is also known for its diverse selection of restaurants of various cuisine. A hidden gem awaits you in every corner of every street. The property is located in an up-and-coming area of the city, and is culturally diverse and has great amenities, packed with cinemas, theaters, concert halls for a great night out. The ancillary retail space, which is located on the first 2 floors of the property, is 100% leased to 28 tenants, anchored by Albert Heijn, the Netherlands' largest grocery retailer and essential service during the pandemic. The building was acquired on December 2019. Typical of Dutch properties, the suites are accessible by multiple entrances and elevator shafts that leads to exterior walkways. This minimizes common area space, and suites have windows at both ends of the units as well as a balcony. It is a 17-story property consisting of 222 residential suites, approximately 9,900 square meters of ancillary retail space, and indoor parking. The property, which was built in 2012, is composed of a high-rise section and a lower-rise contour of residential units. There are 6 unit types ranging in size from 54 to 137 square meters, of which 99% are liberalized. Market rents range from $10.95 to 1680 euros a month, excluding energy, service charge, and parking. The property is 97% occupied, and in 2020, we were able to achieve approximately 13% increase on rental uplift from suite turnovers. The fair value of the property is approximately 108 million euros. Suites, as you can see in this virtual tour, all come with integrated kitchen appliances and a smart thermostat. The installation of floors and fixtures are optional for tenants. Heating and hot water is supplied by what is referred to as city heating, which implies hot water coming directly to the units. In some cases, eliminates the need for a boiler and minimizes equipment. Parking is available for short hourly periods or monthly with 432 indoor parking spaces. A service manager is present on a full-time basis to service the tenants and to ensure a clean and well-maintained environment. The Chameleon is an architectural gem with a rooftop garden of no less than 5,000 square meters, accessible to all residents with running water and tall trees. A beautiful asset. The second property on this tour is called our Overvet properties, located in Utrecht, the fourth largest and fastest growing city in the Netherlands. There is a train station very close to these properties, which can provide you access to Central Station, the busiest hub in the Netherlands. You can reach Amsterdam within 30 minutes, which is an important attraction for these properties. There are also multiple bus lines and easy access to highways if you're driving by car. The properties are located in a neighborhood with a lot of other residential buildings and has access to nearby shopping centers with more than 100 shops and restaurants. There are also many parks and playgrounds in this area, which is ideal for families. The Overvet properties were acquired by ERES on December 23, 2016. It is comprised of 4 buildings consisting of a total of 465 units, all built between 1965 and 1967. There are 3 suite types ranging in size from 54 to 81 square meter, which 35% are liberalized. Market rents range from 457 to 1,200 euros a month, excluding energy, service charge, and parking. The property is over 99% occupied, and in 2020, we were able to achieve approximately 29% increase on rental uplift from suite turnovers, mainly due to the conversion of regulated suites to liberalized suites. The fair value of the property is approximately 100 million euros. Suites all come with integrated kitchen appliances and with a separate toilet from the bathroom with an open shower. Like the Chameleon asset, flooring and fixtures are optional features. The units are stripped to the concrete and fully refurbished, including windows, electrical, and plumbing. There's also some ancillary commercial space consisting of a small 4-floor section that is occupied by commercial tenants such as a language school and community groups. There is one building that contains garage boxes that are available for rental and lockers in the other 3 buildings, also available for rentals. Within this property, there's a potential for redevelopment where a single floor garage is located. We strategically acquired this garage in 2019 for future residential development and intensification. Speaking of the conversion of regulated to liberalized suites, this is our operational strategy at this site. Up to 65% of the units can be converted with an extended renovation that generates significant rental uplift and a high single-digit unlevered returns. Overvet is a profitable asset located in a beautiful and family-friendly neighborhood. For the last part of our virtual tour, we are excited to present to you a very popular rental segment in the Netherlands that is not as common in Canada, the single-family homes. Compared to single-family homes where we think mainly about detached properties, these homes are typically what we refer to them in Canada as townhomes or in the Netherlands as Dutch row houses. These properties are mostly located in secondary markets and in suburbs of the Netherlands. ERES has approximately 2,141 single-family homes, representing 35% of our total portfolio in the Netherlands, of which 56% are liberalized. These single-family homes were acquired throughout 2016 to 2020. As an overall, single-family home are the most popular rental properties within the Netherlands, and the most sites consist of row houses, very efficiently built, with usually 2 to 3 floors, with a front and back garden, and often no parking spaces. On average, the size of the row houses range from 80 to 200 square meters. These types of homes are appealing to the residents because of the larger space and comfort of their home, which allows them to invest to make it their home. Due to the density created by their building, this tends to create strong communities where most neighbors know each other. Operationally, these properties offer efficiency. There is no cleaning and no landscaping, no service charge management, no services, and no amenities. There are no energy management except for vacant units, and most tenants do their minor maintenance by themselves. The only responsibility for ERES is a single boiler maintenance and a typical CapEx program which we manage. Single-family homes offer the flexibility of privatization or single-unit sales, although it is not a strategy that ERES currently pursues. Nevertheless, we think that this asset class provides great optionality for ERES if we ever wanted to start a privatization program, as they are the most attractive sale candidates. They can deliver value upside by crystallizing the higher vacant possession price to owner-occupiers or downside protection as a sort of liquidity if we ever required it. For the operational strategy, this segment is really focused on steady cash flow generation. On suite turnovers, we analyze the renovation level on a unit-by-unit basis to ensure a strong return on investment and good paybacks. Our choices will depend on location, product, and rental potential. Thank you everyone for joining me during this virtual tour today.